Welcome back to my channel. So this is the start of week number 7 in our road to 200k challenge. So the markets started this Monday on a positive note. They are recovering quite well from the losses, the significant losses that took place last week. And so I remain hopeful that this momentum can be carried over the course of the week. Especially, and because this is September 9th today, we are a little bit more than a week away from the upcoming Fed meeting, which will take place on September the 17th and 18th. And so I believe that markets will start to anticipate a potential rate cut by the Fed and potentially a 15-point basis cut, which is precisely what the markets are hoping for. I believe that they won't get satisfied with anything less than that. For example, a 25 basis point rate cut. I think it's not going to be seen as enough of a move by the Fed, and so probably markets will start to discount or incorporate this expectation in stock prices, which will be something positive because markets will probably rise by discounting this particular expectation. But yeah, this is something that is we'll see in the next couple of days. For the time being, I already input the trades for this week. And yeah, let's review each and every one of those, and along as with the rationale, the reasoning behind these trades. So as I mentioned last week, and as you can see in my last video of the week 6 wrap up, I had a little bit more than $10,000 in buying power. And so I decided to continue with the strategy that we are pursuing from the last few weeks, which is basically lower the average price of HIM's stock. All right. As you saw last week, I was assigned 800 more shares, bringing our grand total to 2,200. And so this allowed me also to sell more call contracts. All right, and so I could sell 8 more. But before that, we will continue to pursue the same strategy, trying to lower the average price so that with a smaller spike in price, we can get rid of the entire holding of HIM's stock. And so that's why I went ahead and sold 5 more puts with a strike price of 13.5. The $13 put strike was also available, but the premium was almost meaningless. And because at the time of the trade, the stock was already over $14, I also considered the $14 strike put. But the strike price was too close to the stock price, and so I decided not to go for it. And so I decided to go in the middle ground. The 13.5, the premium was still good, and there was a reasonable distance between the strike price and the stock price, so that we can continue to, by some margin, continue to lower our average price. But as I mentioned in the last video, the current average price of our holdings of HIMS is 1636, not 1625, because this value already discounting the last premium I received to buy the most recent 800 shares. So the real average price is 16.36, and I noticed that the 2-week call with a strike of 16.5 was available, and so I decided to go ahead and sell 8 of those calls. The remaining 800 shares I could use as collateral to try to get rid of these stocks, of these shares. And even though of course this call here will be almost impossible to be exercised because the strike price is too high for the current stock price, but we never know. It's a volatile stock, something can always happen, but for the time being this is the current arrangement. I tried also to buy back, because this call was available, I tried to buy back this call. All right, as you can see right here, the ask price is 5, so I could buy back those for 5. I tried to buy back, of course, for 1, but it was not possible, as you can see. But even so, I went ahead and input an order, which I believe is still here. Yeah, in fact, here it is. It was already cancelled by me. And why is that? Because in the meantime, while I was waiting for the order to fill up, this call of 16.5 became unavailable because in this small period of time the stock price went down. And because it went down, calls become less available and the stock simply stopped being traded. And so I canceled the trade, decided to stay where it is, and let's see what happens in the following days with this call. But if I end up having this call again available and this falls to 1 cent, I will probably buy it back and sell 14 more contracts on this. And if by chance this call becomes exercised and I will get the 22 contracts in this call assigned, I will still profit, because the price that I will sell the shares is 16.50 and the average price is 16.36. So I will have a small capital gain plus all the premiums that I got in between that. So it will be a very good trade, one that I'm really looking forward, but we will see what happens. Also, because I still had some buying power left, all right, and also because I wanted to keep some buying power available, I did not want to dump everything in this particular put or in the 13 strike put, because the premium was almost meaningless. I searched for other puts that I could sell so that I could lower the average price of the current stocks that I have that I want to get rid of. And I noticed that the lift put, the 10.50 put, was selling at a very attractive price. So I went ahead and used the remaining buying power in selling 4 contracts on a 10.50 strike price. If this happens, this will allow us to also lower our strike price for lift, which is currently 14.50, not 15.35, as you can see right here. And just for reference, 0.5, well, we can do it, yeah, this way. Yeah, so it's 14.5 times 5, which is 72.5. And we also have, let's use here the scientific because it's easier to do this. So it's 14.5, wait, times 5, because I have 500 shares bought at this price, and now plus, no, parenthesis, and it's going to be 4 times 10.5. Right, so, and I would have 900 shares, so let's divide this by 9. This would allow us to lower our average price to 12.72, all right, which will probably be possible to start selling calls on this particular stock. And so I mean, probably starting to try to get rid of the entire lot of shares. But we will see what happens. Now, one very interesting trade were these two calls on Pfizer that I sold, and why they are so interesting. As you can see, I sold these two calls. I think it says in there 13 cents. I believe this is correct, and in fact it is 13 cents. And as soon as I input this trade, I was doing other stuff, and then around 15 minutes later I looked again, and at the time when I sold these particular calls, the stock price was around 28.5, so the 29 call was the only option available, because the 29.5 strike call had a too low premium to ever be considered. But in around 15 minutes time, the stock basically spiked at around 29.20 or 29.25, something like that. So I left a lot of money on the table, because this call now is extremely valuable at this point, and probably if I would have placed the trade later, I could have sold the 29.5 call, and by doing that, instead of breaking even, if I sell these shares, I would have a capital gain of around 100 euros, $100, because it's 200 shares with a 15-cent capital gain on each of them. So yeah, it's market timing. So the randomness of the market in the very short run sometimes plays these games with us. It could have gone either way. It could have gone down as well, and that would have been a very, very good trade for us. But as things stand, yeah, there is nothing we can do about it. For the other stocks we have, of course, this call is still ongoing from last week. American Airlines, given this price, we cannot sell calls at a strike that would allow us to break even, because the price is still too low. And the same thing is happening with the 4 motor company shares. So that is it. So let's go ahead and input our trades in our scoreboard. Never mind some of the exchanges, currency exchanges that took place in here, because basically what's happening is that because I deposit in euros but the shares are traded in dollars, they do the currency conversion automatically without any costs for me, without fees, as you can see right here. All right, and so let's go ahead and let's put these trades into our scoreboard. All right, so starting in this case, let's start with the HIMS stock. All right, so let's input here. Today is September the 9th, right? And this particular put will expire on September the 13th, as you can see, next Friday. All right, so 13/9/24, right? So here, right, and now the formula is still applicable. This is a HIMS, right? This is a cash covered put. I'll then rearrange the scoreboard so that we can put the calls first, because now at this point this is not really relevant. I can make this at another time. I sold 5 calls. All right, the price at which I sold this were at 20, all right, 20 cents, and I paid 3.53 in commissions. So 20, and I paid 3.53 in commissions. All right, so for the time being, this is it. Let's move on to another trade. And so the next one is the calls that I sold on Pfizer, and regrettably so, because if I did the trade a little bit later, I would have profited much more out of it. but basically it's also expiring this next Friday. Right, so here is, these are Pfizer shares. This is a covered call. The strike is 29, so if they are exercised, that allows me to break even. Right, these were sold at 13 and the commission was 57 cents. All right, so this is it. Let's move on to the next one right here. And the next one was the calls that I sold on HIMS at 6 cents each with a fee of 4.45. Quite a hefty one, I should say, but given the amount of contracts, I'm not that surprised. All right, so it was 0.6. Right, so this is the same thing. Actually, here it's on the 20th, right? 20th. This is HIMS. These are covered calls. The strike was 16.5. These are 8 contracts, and what it's left is the commission, which is basically 4.45. all right, so 14.45. And I believe there is still one trade left, which are the puts on Lyft with a strike price of 10.5. right, and these ones are also 1 week. Right, so Lyft is a cash covered put, strike price 10.50. these are 4 contracts. All right, and the last thing is a price at which I sold the premium, so 10 cents and 2.84. all right, 10 cents and 2.84. all right, and this is it. I guess we covered everything we could in this video. Now we will need to wait and see what's going to happen. I'm not sure if I'm going to get assigned these shares of Lyft. But I'm very convinced that probably these shares of Pfizer will go and I will sell them, right? And yeah, based on what's been happening on HIMS, it's probable that it can happen that these puts are exercised, and I will continue to add up to my holdings of HIMS at a lower price nonetheless. And I think it's rather unlikely, or very unlikely, that this call is exercised, which of course would be nice, but I don't think it's going to happen. And this call right here is absolutely impossible. I think it's completely impossible that this, unless something really extraordinary happens, this call will not be exercised at all. And of course, we are more than $10 away from this call from being exercised, and so as you can see right here, it's being it is possible to buy it back at 5 cents, which basically says that, all right, this is almost impossible to be exercised and to be in the money, meaning the price rising above 98. So I think that's the way it's going to be until the end of the week. And yeah, basically this is it. We will reconvene on the weekend, next weekend, to see how the trades went. In the meantime, feel free to leave your comments below, like the video, subscribe. You can get in touch with me as always on LinkedIn to discuss the challenge or to put forward any questions you may have. And yeah, this is it, and I'll see you all in the next one.